Good morning, everyone. My name is Sam Metcalf. I'm the Midlands editor at thebusinessdesk.com. And today, in conjunction with Wright Vigar, we're going to be talking about cryptocurrency and the tax obligations for investors. Right now, many crypto investors will be filing a tax return for the first time. If you've been dabbling with crypto assets, today we'll ask, do you understand your tax obligation? Today, we're joined by two experts, Louise Lane from Wright Vigar and Dan Howitt from Recap. We'll be able to plot a path through the crypto tax landscape over the next 45 minutes. We'll meet them in a second. But first, if you have any questions for Louise or Dan today, please do get involved. Simply use the Q&A button at the bottom of your screen anytime during the webinar and type in your question, and I'll do my best to put it to the panel after the end of the webinar. Right, Dan, let's crack on and find out all about cryptocurrency and tax. I'm going to ask you to share your screen now so you and Louise could run through your short presentation. Over to you, Dan.
Sure, just firing them up. Okay, you should be able to see my screen.
Cool, so I'll start then. I'm Louise Lane of Wright Vigar. We're going to look today at, are you crypto tax savvy? The session overview is going to cover Dan, starting with what is crypto, so we can really get to the nuts and bolts of what crypto assets are, how the market currently is, and how people are feeling about investment at the moment in crypto. I'm going to then progress with looking at your crypto tax position, what kind of liabilities are you creating with all this activity, and also think about the compliance activity that we're starting to see from HMRC and what might be heading in the future landscape. Just a general caveat, we can't give investment advice, so please don't take anything we're saying as an encouragement to buy or sell crypto. You have to navigate those decisions yourself. As a tax advisor, I can only comment on the tax consequences of transactions. However, all of this is designed as generic advice. The devil's always in the detail with tax, so you just have to really focus on your specific circumstances, because tiny little nuances in your situation might make it different to the norm, and it's really important to get specific tax advice for your situation. I'm the head of crypto at Wright Vigar. We're a traditional firm of accountants for over 40 years, and over the past 4 years, we've been heavily involved in crypto, mainly because of my work that I've been doing with recap.io, and that's where Dan comes in. They've built some recap. They've built some tax calculation software for crypto so that you can work out your taxes as an individual or as a business. And I've helped them along the way with that, and also written their UK tax guide on crypto assets. We've got broad ranging crypto clients, whether they're individuals or businesses. And Dan and I work together really closely with Crypto UK, who are the leading crypto body. We have a tax working group where we liaise with HMRC and Treasury, trying to navigate the tax legislation and improve it. I think that's everything on me. And I'll hand you over to Dan, who's a leading industry blockchain and crypto expert.
Hello, thank you, Louise. So welcome to this crypto double act with myself and Louise. A bit about me, I'm Dan, I'm co-founder and CEO of Recap. We're a crypto tax accounting platform. Since 2019, we've been helping to support UK individuals in calculating their cryptocurrency taxes, automating them so you don't have to worry about them. And I've got quite an experience in crypto dating back all the way to 2013, when my startup back in the day was one of the first UK companies to define Bitcoin's regulatory position here in the UK. So I'm a software engineer by trade, and a few other hats that I wear is I work with Louise quite closely at Crypto UK. I co-chair Crypto UK's tax working group, and I've recently co-led the response to HMRC's DeFi lending and staking call for evidence. So we're both very involved in UK tax policy regarding crypto assets. And let's jump into the presentation and find out what is crypto. So crypto, what is it? I'm sure you're seeing it all over the media at the moment. There's lots in the media around FTX, Celsius, BlockFi, all of these exchanges going bankrupt or going under or in Chapter 11 bankruptcy proceedings. I like to call that the noise, and the signal is user adoption, and the noise is always the price. So I ignore the price and follow the user adoption. And I hope we get across in this presentation that crypto is kind of like this unstoppable force of nature, and that anybody can participate in, and it is simply not going away. So what is crypto from HMRC's perspective? So HMRC say that crypto assets are cryptographically secured representations of value or contractual rights that have the potential to be transferred, stored, or traded electronically. So it's important to note that, you know, crypto is a very new asset class, and it's a nuanced asset class. It's a completely new type of private property that, you know, even the Law Commission acknowledges doesn't easily fit into current private property law. And the main sticking points seem to be around ownership, because with crypto assets, you don't technically own them. Instead, you control them. So we've seen recently from UK government in April that there's an ambition for the UK to become a crypto hub. And I think, you know, in order to get there, we need to start to see crypto assets being recognised in English and Wales law in order for that to happen. There have recently been some court cases relating to crypto, and, you know, the judge has ruled that crypto is property. All I'm trying to do is highlight here that it is a nuanced asset class. Everyone's learning, including government, Treasury, HMRC, and the courts at the same time. So crypto assets, they're new, and they came to light in the 2008 financial crisis with the release of Bitcoin. So Bitcoin is very famous for having an anonymous creator called Satoshi, who encoded the times, 3rd of January 2009, Chancellor on the brink of a second bailout for banks, into the first Bitcoin blockchain. So this is a statement that was plastered all over newspapers at the time. You know, we were expecting a second bailout for banks, and somewhere in the world there was this anonymous creator who decided to bake that message in to the first ever Bitcoin transaction. And that message is there for life. It's never going to go away. It's stamped in there forever. And what's interesting about Bitcoin is that it was modeled pretty much to be a digital representation of gold, a digital store of value that perhaps could compete against, you know, all the problems that we were seeing in 2008 and 2009. So Bitcoin has a fixed supply, and it's difficult to create. So again, going back to the modeling on gold, well, gold's difficult to take out the ground and mine. And the same for Bitcoin. It's difficult to create it. It's difficult to mine it. So Bitcoin is really good at doing one thing, and that is maintaining a decentralized ledger of Satoshis, which is the base unit of account for the Bitcoin blockchain. And there are roughly 100 million Satoshis to a Bitcoin, but for some reason we use Bitcoin as the main unit of account. So what's revolutionary about crypto assets is that they can be owned outright in self-custody. No banks, no custodians, no middlemen. It's a bit like storing cash under the mattress. You can actually hold your own assets yourself, and therefore you're not subject to counterfeiting or hacks or a bank going under or a crypto exchange going under. And because you can hold your assets in self-custody, that means you can transact them freely and frictionlessly around the world at a very low cost to anyone that has a computer or even a smartphone. And, you know, where we're starting to see, you know, major crypto asset adoption is not in the UK. It's actually in places like Africa or Vietnam, where it's being used as a medium of exchange, because, you know, the majority of those populations are unbanked. So crypto assets, they're a paradigm shift because they utilize distributed ledger technology. They're borderless, global, accessible to anybody. And crypto is evolving. It's not just Bitcoin or Satoshis that we're kind of sending around the world to transfer value. It's now tokens that represent artwork. It's tokens that could be used in games. There's an image up there of FIFA Collect, which is a trading card NFT platform that's launched for the World Cup. So crypto is evolving, and I work in this space full time, and I struggle to keep pace with the innovation that's happening in this industry. So what does the crypto market look like? So this is where I want to get across the whole signal versus noise. The media's focused on the price of Bitcoin. I'm focused on the user adoption. So around the world, there are 350 million cryptocurrency users. And a recent survey from HMRC showed that 10% of UK adults have held crypto assets at some point. So I put that at around about 2 to 3 million people in the UK have actually had crypto assets at some point or still own them. So I think that's quite a large demographic of our society. And of that survey, 53% of the owners had holdings of over £1,000 worth of crypto, and 7%, £5,000 or more. And this is when we're starting to get people that kind of encroach, into capital gains tax territory if they've been trading. What's really important to know is that there's a cohort of crypto asset user that are involved in what's called decentralized finance. So with traditional finance, you might be a really high net worth individual like an Elon Musk, and you can use your assets to kind of leverage your position and take out loans against your stocks to acquire other companies. Maybe you can lend your stocks out and you can earn yield on them. That's only accessible to the high net worths. But with decentralized finance and crypto, it's accessible to everyone. And we've seen an explosion of people lending their assets out for yields or loaning them, participating in things like liquidity pools. It's all quite complex stuff. But in a way, it's just a way of earning passive income on your assets. So there are some challenges around, how all of these things should be accounted for, but we're seeing a massive explosion in people using these services and protocols that allow you to earn yield on your crypto. So this is by far my favorite chart. I speak to a lot of people that still kind of dismiss crypto as a thing. And this is the chart that I always send them back in an email. And this is Bitcoin's user adoption curve. So in green, you can see the number of crypto users, not Bitcoin, sorry, the number of crypto users globally. So right now, there's about 350 million crypto users in the world. By 2024, if we follow the same user adoption curve, there'll be 1 billion users that have crypto. And again, if we follow the curve further, 2030, we'll have 5 billion users. So what we're seeing is a technology that is growing at a similar pace to the internet or mobile phones. And these technologies do not go away because they're all based on network effects. And once network effects get going, there's no stopping them. And here's a quick chart on, I mentioned decentralized finance. This is just kind of like really showcases the explosion in people utilizing their crypto assets to earn yield or passive income. And you can see it really took off kind of like January 2020. And, it's probably, 1,000 times user adoption growth just in this area. Okay, so that's all I wanted to talk through. I'm going to pass you over to Louise now, that's going to talk about crypto tax.
Cool, thanks, Dan. So yeah, we're going to look at how crypto assets are taxed and why it's so essential to have software for this. So the first thing to think about is which taxes apply to your crypto asset activity. Historically, there was some very brief guidance from HMRC back in 2014 that more or less implied that it might be non-taxable as gambling. Clearly, everyone jumped on that. HMRC have been really clear when they produced their detailed guidance in 2018, and they go at pains every conversation since to say that no, this is not gambling. It never was. Definitely taxable in some kind of form. The next thing you need to think about is this a business? Am I trading so much? Am I buying and selling crypto to such an extent with such a level of organization that this is actually a business? And surprisingly, HMRC only expect this in exceptional circumstances. They're expecting most people involved in crypto assets are just investing. They're buying maybe for the long-term hold, for capital appreciation. Maybe they want to earn some yield along the way, like Dan was mentioning, realizing some income from their assets. So in most cases, we're looking at capital gains tax for the buying and selling of crypto, and then we need to look at the income that's earned from that a little bit separately. So when it comes to income, you need to think of crypto assets as maybe like foreign currency. You're receiving some kind of value, but just in a different kind of currency. So if you've got employment or self-employment contracting work, and you're paid in crypto instead of in, sterling cash, then you need to treat it as though you're receiving that sterling equivalent at the date of receipt. So let's say you receive half a Bitcoin for some consultancy work. You need to convert that to sterling at the date of receipt and record that as income. For mining, any rewards, whether it covers staking, mining, lending, all of these rewards are taxable. However, they're taxed as something called miscellaneous income. It means that it's subject to income tax, but there's no national insurance like you would have for a business. So for these kind of yield generating activities, most of the time it's going to be treated as income, and most of the time subject to income tax. There are some limited expenses you can offset and allowances, but they're not very generous. And what's most important is when you've got miscellaneous income, you can't deduct hardware costs like mining rigs, for example, which are quite pricey from the tax bill. Airdrops tend to be a marketing campaign generally. For example, if someone's got a new token that they want to get out into the marketplace and get a bit of a buzz about it, they might say to Binance, one of the cryptocurrency exchanges, can you distribute this to everyone who has an Ethereum wallet, for example? And generally these are non-taxable. It just depends if you do anything in return for them. If you're providing some kind of services in return for getting the airdrop, then they're taxable, but if not, they're generally tax-free. From an investment point of view, if you're buying and selling crypto, the really critical point you need to determine is when is a disposal made for tax purposes. So most people kind of realize that if they're cashing out for what we call fiat, so a government-backed currency like GBP, USD, euros, most people realize that selling crypto for fiat will be a taxable disposal subject to capital gains tax. And that is right, but there are also at least 4 other situations where you need to think about a disposal to record. So if you swap one crypto for another, then that's effectively a barter transaction, and that's a disposal of one token and an acquisition of another one. And a lot of people over the years have missed that and not realized the tax consequence of those events. If you pay for goods or services in crypto, then that's a disposal of the crypto that you've used to buy the goods or service with. And the most common thing we see is almost every crypto transaction has a fee, a very small fee, but that's in crypto. So maybe you're selling Bitcoin for ETH and you'll pay a fee in Bitcoin. And so that's a disposal of Bitcoin that needs recording and working out the market value at the time of disposal, and working it into the horribly complex share matching rules, which is of course why software is so essential. If you're giving away crypto assets, you can give away to a spouse, providing certain conditions are met, and she can give away to a qualifying charity, and they're no gain, no loss. So there's no tax effect for CGT of giving them away. But a gift to anyone else, whether it's a friend, brother, sister, etc., they're all taxable events. So even though you're giving it away for free and receiving nothing in return, it's treated as though you've sold it for its full market value, and that's taxable. Finally, there's absolutely no time to go into the detail of the beneficial ownership argument, but we were hit with really controversial guidance in February last year from HMRC that says that if you lock away your tokens in some kind of yield generating activity, it might be you lock them away in a staking protocol, you might put them in a liquidity pool, you might lend them out, or you might add them as collateral in exchange for some kind of loan. In those circumstances where you're locking your tokens up, we've now got to consider, has beneficial ownership of those tokens transferred to another party, platform, person, protocol? And if it has, HMRC is saying that at the time of locking them up, that's a disposal for tax purposes, and then you have to reassess when you get the tokens back again. And so it's a really, really nasty piece of guidance that potentially means you're creating what we call a dry tax charge at the point of going into an investment where you've got your tokens are locked up, but you're creating a tax charge that's got to be paid regardless of when you unlock those tokens. Yeah, really, really harsh. We're hoping to get some changes on that, but with the changes in government at the moment, progress is just so slow and we're not getting any answers at the moment. So how to calculate the capital gains tax? This leads into recap and why it's so important to have software, but you need to apply a sterling value to every crypto transaction. So if you have a swap of Bitcoin for ETH, there is no sterling value associated with either of those, but you need to apply one in order to work out the taxes. So the beauty of the software is you upload all of your transactions, they apply a sterling value to every transaction, and then the way the capital gains tax is worked out is the same way as we tax shares, traditional shares. You have to pool every crypto asset into their own sort of individual pool. So let's take Bitcoin as a crypto asset, for example. Every time you acquire and dispose of Bitcoin, that interacts with the Bitcoin pool. So whenever we've got a disposal of Bitcoin, we need to know whether we need to match it against a same-day acquisition of Bitcoin, an acquisition in the next 30 days, or if not, we take the average cost from the Bitcoin pool. And what we typically see is investors in crypto will have so many different exchanges and wallets where they're interacting that the software layers it all together, because you can't work out your tax position for your activity on Kraken and then your tax position on Coinbase. It has to be all interlinked, and therefore the software aggregates this all together and then beautifully applies the matching rules to give us the tax position. A very, very simple example would be we bought Bitcoin, one Bitcoin for £20,000 in January 22. That gets added into the Section 104 pool. This is the average cost pool for Bitcoin because there's no disposal for it to be matched with same day or next 30 days. So we then sell one Bitcoin and trade it for ETH a few months later. We have to value the Bitcoin, which is also the value of the ETH at the same day. And we've got a disposal of Bitcoin for 25,000. We've got an acquisition of 10 ETH for 25,000. So looking at the Bitcoin, we've disposed of it for 25, we bought it for 20, so we've got a capital gain of 5. That's subject to capital gains tax at the end of January following the end of the tax year. And then moving forward, we've got 10 ETH, which has got a cost in its own Section 104 pool of 25,000. So when that's eventually sold, that cost will interact with that future disposal. And I'll hand over to Dan to tell you more about recap and how it can help.
Thanks, Louise. So as I'm sure you can see that, calculating your crypto taxes can be quite difficult. It's a new asset class. There's an explosion in people using it. HMRC are releasing new guidance. And what my company does at Recap is it helps put your crypto asset accounting on autopilot. So just quickly, how we do that is, number one, we focus on portfolio unification. So we connect to all of the places where you can buy or sell crypto and pull in all of your transaction records. And when we've got all of your transaction records, we can then do all of the complicated stuff that Louise has just mentioned, like valuing your cryptocurrency in pounds, applying Section 104 rules, the 30-day rule. And we actually do this for UK, US, and South African tax regimes. Louise, I'm just going to hand you back now to talk about the impending tax storm. It sounds quite scary.
It does, yeah. So I just think it's really important for people to know that since HMRC released their guidance in December 2018, they've been fairly relaxed about compliance with taxpayers, not players. I kind of call it, they've been in their education phase of they're trying to give people the benefit of the doubt, trying to give people time to get on board, understand the new rules and bring their taxes up to date. So we find that when we make voluntary disclosures of prior years to HMRC, they're generally very receptive to that. However, we're seeing lots of signals, we have seen over the last few years, where HMRC are definitely moving into more of a compliance phase. Key to that is the CARF, which is the Cryptoasset Reporting Framework. At the moment, a lot of the exchanges where you buy and sell crypto are outside of the UK. So at the moment, it's really hard for our HMRC to go to them and request information about UK taxpayers. The whole idea of the CARF, when this is adopted, is that all exchanges around the world will be required to automatically send reports to HMRC about UK investors' activity. And this will happen automatically. So I think that's definitely a clear signal that HMRC are going to take a keener interest in making sure people have paid the right amount of tax. Certainly, have you got the slide? The next slide, yeah, thank you, Dan. Mm-hmm. You know, they issued the guidance late December 18. They've notified the UK user base of Coinbase that Coinbase notified their UK user base that they were sharing info with HMRC in October 2020. And then we have seen compliance activity come out of that. HMRC have been in touch with taxpayers to say, you know, we understand you've been dealing in crypto assets. We've had some general nudge letters sent out in November 21, so a year ago, where they're just really prompting taxpayers to think about their crypto asset tax position. And I know that that's a really cost-effective way of HMRC not really having to do much to trigger a lot more compliance. We know behind the scenes they've been trying to get some software to really interrogate the blockchain and find out for themselves what activity people have been doing. So there's definitely increasing compliance pressure from HMRC, and certainly the fact that they've got a lot of black holes to fill with funding. They're going to need to raise money from somewhere, and this is a really good way for them to raise money. Dan, do you want to give the summary?
Sure, yeah. So we'll summarize this presentation as, you know, part one, the crypto market is one of the fastest growing we've ever seen. It's on par with like the internet's growth or mobile phone adoption growth, up to 5 billion crypto asset users by 2030. And the network effects of crypto kind of make it this unstoppable force that isn't going away. And, you know, the tax authorities are steadfast in their approach that, you know, crypto assets are here to stay, they're property and hence subject to capital gains tax. And they're beginning to intensify how they look at compliance in order to ensure there's like a level playing field, that people are paying their taxes. So yeah, thank you very much for your time, and happy to answer any questions.
Thanks, Dan and Louise. That's really interesting stuff, and I certainly made it a lot clearer for me. We have got a couple of questions from the audience. First one is giving away crypto assets the same as selling them? Who wants to take that one? Dan, you want to go on that one?
I think it's probably more one for Louise.
Should I take that one? Yeah, so it depends who you're giving them to. So yes, it is treated as selling them. Whenever you use crypto assets at all for anything, it's effectively treated as a two-stage transaction. You're selling it for its sterling market value, so you've got a disposal for capital gains tax purposes, and then you use those sterling proceeds to give them away to effectively someone. And I know that's not what happens. You would transfer, for example, the Bitcoin from your wallet to someone else's wallet, but it's treated as though you've sold it and given them the cash effectively. So if you've got a transfer to a spouse and you still live with them, you're still married, then that would be no gain, no loss. So there's no tax there. If you give it to a qualifying charity in the EEA, then that's also no gain, no loss. But any other gift to any other person is taxable, as though, let's say it's a Bitcoin worth 20 grand and you give it to them for free. You're treated as though you've sold a Bitcoin for 20 grand, and then depending on what the matched acquisition cost on that is, you possibly got a gain or a loss subject to tax.
Louise, Dan, Nicola wants to know if there's a limit on transactions which can be processed through Recap.
It's a very good question. So when we first built Recap, there was basically Bitcoin and Ethereum as two of the main assets. And people would generally have, up to a maximum of 1,000 transactions. Now, since 2017, we've seen an explosion in crypto assets. There's over 4,000 crypto assets traded on exchanges around the world at the moment. And you can now participate in lending activities, staking activities, where you might be receiving daily income. So as a result of that, we have had to adapt Recap, and we can support upwards of about 150,000 transactions in our software at the moment. But we're proactively having to scale it to deal with, people that are potentially creating millions of transactions at the moment that need accounting for.
Yeah, Nicola's just followed up there saying one of their clients has with airdrop so many NFTs this last year that he breaks most tax software thresholds.
Yeah, it's a common problem. Yeah. And I would say it's endemic of, all crypto tax platforms. Our competitors are dealing with the same issues as well. We've just seen this massive explosion in transactions because you can do just so many things now with crypto. It's difficult for us to keep pace, but we are addressing it.
Thanks, Dan. Louise, back to you. A question from Michelle. She wants to know if capital gains rules apply for crypto losses.
Yes, they do. So if you're investing in crypto, if this is an investment and you're subject to capital gains tax, then if you generate a capital loss, it will automatically get used against any other capital gains in the same year. And this is not just a crypto thing. So you can't just use your crypto losses against your crypto gains. Any capital gains, whether they're gains or losses, are intermingled. So you might have a loss from crypto and you can offset it against a property gain or a gain on traditional stocks and shares. So any loss in the year will automatically be offset against any other gains in the same tax year. And if there's a net loss overall for the tax year, then all we can do with that is carry it forward against future capital gains. We can't carry it back, unfortunately, which is a real common question we're going to get at the moment, because people are seeing losses in this current year and they're wanting to carry them back against their huge tax liabilities for the 21-22 tax year.
Steve's also asked, if I sold at a loss before the end of the current tax year and then repurchased at the start of the new tax year, can he offset previous year's losses, I guess?
You've just got to be really careful with the bed and breakfasting rules. This is the reason why we've got the complex matching, where if you make a disposal, let's say you make a disposal on the 5th of April, which is the end of the tax year, 5th of April 23. If you acquire that same token, and you might not buy it back, you might acquire it via some employment, or you might acquire it via lending rewards or staking rewards, but any acquisitions in the following 30 days are treated as though they were sold in the period 30 days earlier. So let's say, you sold at a price of 10 grand per Bitcoin at the 5th of April, and then you buy back a few weeks later, within 30 days, then if you buy back at 15 grand, you have got a capital loss of 5 grand there. But if you actually buy back for 10 grand, then you've got no loss at all and you haven't achieved what you were trying to do.
Dan, what does the average crypto investor look like?
Yeah, it's quite diverse. So I would say it's a younger demographic than, you know, somebody that's trading in stocks or shares. You know, our customer base they generally don't own any other major type of assets like stocks and shares or even a property. They are purely into crypto. And what's interesting is that they tend to come to recap when they have got a big purchase in mind. Maybe they've made a lot of money. And they want to buy a house and they want to get everything in order is when we typically see them. And obviously in tax season as well to get their self-assessment tax return in. But I would quite confidently say that unfortunately it's males. And I would say, you know, under 40s are the kind of main demographic there.
For sure, but not exclusively. I've got quite a few.
Not exclusively.
I've got quite a few senior citizen clients as well.
Okay, I mean, just one more from me. Crypto's become mainstream news, hasn't it, over the last week or so? It's off the most news agenda with the collapse of the FTX platform. What does this mean for the industry now? Can it recover from this? I'll ask that to both of you. Let me go first. Dan.
I'll go first. Yeah, I mean, I've been in crypto a very long time. I've been in crypto since 2013, and I've seen, you know, probably 4 market cycles now, where we've seen incredible highs followed by incredible lows. And you know, as I was trying to allude to in the presentation, I think the price, which is what the media focuses on, you know, obviously that is impacted by these market cycles, but the fundamentals of the technology and the user adoption growth show that this is just an asset class that isn't going away. And I like to think of this as, you know, in 1994, 1996, the early internet, if you could buy Amazon stock or Google stock, you know, if you could go in a time machine, you'd do it and it would become, you know, worth a lot of money 10, 20 years later. And I think crypto is a similar kind of binary bet. You allocate some capital, you leave it for a decade or two, and it's either going to be worth a hell of a lot or nothing, and everything else in between now and then is noise. It's just a result of how the technology manifests, and there's going to be bad actors in the space like FTX that, you know, effectively there's some fraudulent activity there, there's a misappropriation of customer funds. Doesn't matter what business you're involved in, there's always going to be bad actors, and I think the industry will recover from that quite quickly.
Louise.
I think the FTX collapse, it does really emphasize the beauty of decentralized. So FTX was a centralized exchange. You know, someone has control of that, control of your funds. You know, it's going to encourage a lot more people that, yes, they might use an exchange to buy and sell, but then pull it back into self-custody, you know, protect your own crypto assets, look after them yourself, and don't be at the mercy of someone else looking after them for you. Yeah.
Just one for me before we go. Stick it right back. What one piece of advice would you give to somebody completely new to crypto who's looking at building an investment portfolio right now? Dan, you first.
So I would say that, you know, we've highlighted like how complicated it is to do all the tax management on this stuff, and it's as complicated as you want to make it. You know, if you get involved in crypto and you decide you want to get a position in the market and you take a long-term view, you might decide you're going to buy a Bitcoin or a percentage of a Bitcoin. Well, you buy it, you put it in self-custody and forget about it for a couple of decades or whatever. You've got no tax consequences as a result of that during that time. You don't really need to keep track of it. There's no disposal events. It's simple. And when, you know, a couple of decades down the line when you want to sell it, the tax is actually quite simple. You know, it's just capital gains tax and maybe one sale. But if you're involved in lending and staking, if you're involved in collateralized loans, you know, if you're doing all of these weird and wonderful bleeding edge things, then there will be tax consequences. And that requires you to be more proactive in managing your finances, managing your accounts, and potentially could put you, you know, a greater exposure to being under the microscope from HMRC as well.
Louise.
Yeah, for sure. I just emphasize what Dan's saying. I would rather people are downloading all of this really valuable data on their crypto transactions on a regular basis. You know, set a diary appointment for once a month. It's a chore, but, you know, take CSVs of all your transactions from all the exchanges, because if something does happen to them, you've got no data anymore. And you might think, oh, well, that's quite nice, no one knows about what I've done. But, you know, you might have all the disposals, but you don't have all the data about when you purchase those crypto assets, which help you reduce those future gains. So it's really, really important to, you know, methodically export your data from whatever you're using, and then do upload it into some crypto software. It doesn't matter if you don't think you've got a tax position to file yet. The beauty of something like Recap is keep your data up to date. It will help you with contemplated transactions. You might think, well, you know, do I want to sell my Bitcoin? I know how much it's worth. If I sell it, what kind of tax impact will that have? And also, it just makes it a lot easier when you do come to needing to file a tax return, because everything's in there. You can't just do your tax, you know, you can't just fly under the radar for 4 years and then in 4 years' time think, I need to do a tax return now because I've made a gain. Because in order to do to work out your taxes on a current transaction, you need every transaction that you've ever done in that token kind of builds over time, and you can't just kind of dive in when you think you need to declare a gain. You've just always got to have that history.
Listen, some absolutely essential advice, I think, over the last 45 minutes. It's clearly one of the most dynamic industries out there, isn't it? And we'll carry on hearing more and more about it, I'm sure. I'd like to thank our audience today who came in live, and also people watching this in the future. Thank you to Louise and Dan, and thank you to Wright Vigar for sponsoring. We'll see you again soon. Bye-bye.
Thanks a lot. Bye-bye.